Say goodbye to tension and hello to your pension. I'm going to talk about 4 ways retirees can tap money from work retirement plans like 401ks. So work retirement plans are fantastic and optimal vehicles for growing and accumulating wealth, but most aren't built for money flowing out of the plan and into your pocket. So following are some options you have in withdrawing money from your work retirement plans. Number 1, keep the money in the plan. If you're under age 72 and have over $5,000 in the plan, you do not need to take money out of the plan. You cannot be forced out of the plan. Some 401k plans have very competitive fees. A lot of work plans do. So if you have a good plan, you might want to leave the money there, okay? So check with your advisors and things to make sure it is a good plan. If you're under 59 and a half, you may want to leave money in your plan to avoid the 10% penalty that the IRS charges on pre-59 and a half age withdrawals. There also are some provisions that you separate from service after 55. You may not owe that 10% penalty. You'll need to check with your plan and your advisors on that. If you're retired or an owner who's still working and over age 72, you need to take required minimum distributions from all IRAs and work plans. If you don't take these distributions, the government subjects you to a 50% penalty, which means you're pretty much paying tax on the whole thing. So definitely you gotta make sure you're taking your required minimum distributions. Number 2 is rolling your account into an IRA. An IRA does usually have more flexible investment options than a 401k plan, and they're really built for accumulation and distribution. It's easy to set up distributions from IRAs. So by rolling into an IRA, you continue to defer taxes and you can start taking distributions from the account. There's 2 types of rollovers. One is a 60-day rollover where your 401k provider will send you a check directly. You have 60 days to put that check into an IRA. If you miss that window, that distribution will be added to your taxable income for that year. So make sure you get that in on time. A direct rollover goes pretty much from your 401k provider directly into the IRA electronically. It's a trustee-to-trustee transfer, so you don't have to worry about taxation. Every plan handles this a little bit differently. Number 3 is you could just take a lump sum payment. If you take a lump sum payment though, the whole amount is subject to regular income tax, which could bump up your bracket. It's usually not a prudent strategy. Usually these are also automatically taxed at 20%, and sometimes state tax is also put in that as well, automatically. So you could, if you cash all the money out, you lose a tax deferral going forward, and you just really need to be careful with that strategy. The 4th strategy is really convert to a Roth IRA. Now this is like a lump sum distribution because you're taking money out of the plan and you're going to pay tax on it, but you can then convert that money into a Roth IRA. And for Roth IRAs, you never pay tax again. They grow tax-free on that money. Okay, the option isn't for anyone, and sometimes maybe you want to do a chunk each year to convert from traditional to a Roth IRA, but it's a good strategy you may want to consider. Okay, so taking distributions from taxable retirement accounts doesn't have to be complicated. Make sure you work with your accountant and your financial advisor to review your options and build the best strategy for you. Thank you.